In April 2025, the world's financial system was rocked by a shock no one could ignore. Trading floors from New York to Tokyo were awash in red, panic spreading beyond the usual circles. China, America's top economic rival, dumped U.S. government debt, long considered the world's safest investment. U.S. bond values plunged, interest rates soared, and the dollar weakened. The bedrock of global finance trembled. The global order had changed, perhaps forever. To grasp the impact of China's move, you need to understand U.S. Treasury bonds. These are IOUs from the U.S. government, sold to fund everything from infrastructure to defense. Investors worldwide, governments, companies, individuals, buy these bonds, trusting the U.S. will pay them back with interest. For decades, Treasuries have been the world's safest investment, forming the backbone of global finance. Central banks from Tokyo to London hold vast amounts as reserves, stabilizing their currencies and providing security. This global demand keeps U.S. interest rates low, making borrowing cheaper for everyone. China became a major player, amassing huge reserves of U.S. debt as its economy boomed. This arrangement benefited both sides. China had a safe place for its dollars, and the U.S. enjoyed low borrowing costs. At its peak, China was the largest foreign holder of U.S. debt, creating deep financial interdependence. But this also created a vulnerability. If China sold off its holdings, it could flood the market, driving down bond prices and pushing up interest rates. That's the financial weapon analysts feared. A sudden sell-off would make borrowing more expensive for the U.S. government, businesses, and consumers. The entire economy could slow down. China's leverage was real, and in April 2025, it was finally used. The world's trust in U.S. debt had been a pillar of stability. But that trust was now in question. The sell-off exposed the risks of relying on a single country's debt as the world's safe haven. The global financial system was more fragile than anyone wanted to admit. The U.S. faced a new reality. Its economic strength was no longer unassailable. The era of easy borrowing was over. The consequences would ripple far beyond Wall Street. The world was watching and recalibrating. The rules of global finance had changed overnight. The financial shock of April 2025 was the climax of a long-simmering trade war. The U.S. accused China of unfair practices and responded with massive tariffs, escalating tensions to new heights. In early April, tariffs on Chinese goods soared to 145%, a direct economic assault. China hit back, raising tariffs on U.S. products to 125%. The world watched as negotiations gave way to open confrontation. Global supply chains shuddered, and recession fears grew. Stock markets plunged, and the dollar weakened as investors braced for impact. The trade war had become a struggle for global dominance. With tariffs peaking, China looked for new ways to retaliate. The timing was no accident. China's bond sell-off came as the tariff battle reached its peak. Beijing had opened a new front, targeting America's financial foundations. The message was clear. Economic warfare had entered a dangerous new phase. The stakes had never been higher. In the week before April 11, 2025, the U.S. Treasury market was hit by a wave of intense selling. The yield on the 10-year Treasury note spiked by 0.5%, the biggest jump in 5 years. Longer-term bonds saw even more volatility, with yields reaching multi-year highs. Most of the selling happened during Asian trading hours, fueling speculation that China was behind the move. This wasn't a slow reduction, it was an aggressive, disruptive dump. Official data later confirmed it. China sold $8.2 billion in U.S. Treasuries in April, dropping its holdings to the lowest level since 2009. The pace of divestment had accelerated into a sprint. The message was unmistakable. China was rapidly reducing its exposure to U.S. assets. The impact was immediate. U.S. borrowing costs jumped, and higher yields rippled through mortgages, credit cards, and business loans. The entire economy felt the break. The sell-off was a stark reminder of how interconnected and vulnerable the global financial system is. Actions in Beijing sent shockwaves to households and businesses worldwide. The world had just witnessed a real-world stress test of global finance. The results were sobering. The old certainties were gone. The new era had begun. As markets reeled, one question dominated: was China weaponizing its treasury holdings? Many believed the sell-off was calculated retaliation for U.S. tariffs, a direct hit on America's financial stability. The timing, coinciding with peak trade tensions, seemed like a smoking gun. Aggressive selling during Asian hours pointed to a state actor, Some analysts noted China might be shifting funds into European assets, punishing the US while diversifying away from the dollar. The move was a powerful, non-military show of strength. For years the US enjoyed the privilege of the world's reserve currency, but China's holdings were always a double-edged sword. The April sell-off was a warning. US policies could have severe consequences. But this strategy wasn't without risk for China. Dumping treasuries could devalue its remaining holdings and strengthen the yuan, hurting Chinese exports. Some experts argued China was playing a dangerous game that could backfire. Retaliation had costs on both sides. The financial battlefield was fraught with peril. Not everyone saw the sell-off as a weapon. Many economists argued it was part of China's long-term strategy to diversify away from the dollar. The trade war simply accelerated a process already underway. China feared the US could freeze its assets in a future conflict, as seen with Russia. Selling treasuries and buying gold was a defensive move. Meanwhile, some experts blamed the market chaos on forced selling by hedge funds, not just China's central bank. Margin calls and rapid unwinding of complex trades amplified the volatility. US officials downplayed the idea of a deliberate attack, noting that a massive sell-off would hurt China too. The sell-off was concentrated in long-term bonds, not typical of a political signal. It reflected a broader loss of confidence in US assets. Investors were reallocating away from the dollar amid unpredictable US policy. The truth was likely a mix of motives: retaliation, diversification, and market dynamics. The result: a global loss of faith in the old financial order. China's Treasury sell-off sent shockwaves far beyond the US. Confidence in American assets was shattered, ending decades of safe haven status. Investors fled to gold and other currencies, seeking safety outside the dollar. Central banks, led by China, ramped up gold reserves. Money flowed into euros and German bonds as the world sought alternatives. Other major holders like Japan and the UK also reduced their US debt exposure. This was a systemic shift, not just a Chinese move. The implications were huge. Higher US borrowing costs, diminished global influence, and weakened power to use financial sanctions. The sell-off was a wake-up call. The global order was shifting. The world was moving toward a more multipolar financial system. The US could no longer take its privilege for granted. The tectonic plates of economic power were moving. The future of global finance was up for grabs. The world was watching and adapting. April 2025 was a turning point for the world economy. The crisis revealed that deep economic ties can be both stabilizing and dangerously fragile. For the US, it was a humbling reminder: global trust is not guaranteed. Aggressive policies can erode the foundations of financial leadership. For China, the risks of wielding financial power were clear. Retaliation could backfire. The episode reinforced Beijing's push to diversify and build alternatives to the dollar. For the rest of the world, the lesson was to hedge against superpower conflict. The flight to gold and other currencies was a strategic shift, not just a panic. Countries are now accelerating efforts to build a more balanced, multipolar system. The Great Treasury sell-off was a warning about the fragility of our interconnected world. Economic tools can become weapons, and trust is hard to rebuild. The path forward demands stability, cooperation, and respect for the rules. The tremor of 2025 left a lasting crack in the foundation of global finance.